So how exactly does a 19-year-old Warren Buffett transform from a completely naive speculator into a billionaire? Well, it all started by reading one profoundly impactful book. In this explainer, we're going to cut right through today's get-rich-quick noise, and we're looking at the actual foundation of true, lasting wealth. It's all laid out in Benjamin Graham's absolute masterpiece, The Intelligent Investor. And you know, this isn't just theory. This is literally the exact playbook that the most successful investor of all time used to build his entire empire.
I mean, just think about the sheer weight of this statement for a second. Warren Buffett literally said reading this book at 19 changed his whole life. When you actually crack it open, you'll quickly realize it doesn't offer some magic, secret formula to predict the market or get rich overnight. Actually, scratch that, it's more like it provides a bulletproof psychological framework to survive the modern market casino. It teaches you exactly how to think about money, risk, and value in a way that keeps your money safe while everyone else is out there losing their shirts. All right, so here's the game plan for today. We're going to break down the 5 biggest mindset shifts from Benjamin Graham that'll take you from market chaos to calm, calculated ownership. 1. We'll meet Mr. Market. 2. Stop speculating. 3. Build a margin of safety. 4. Pick a side. And 5. Master your emotions. Let's dive right in.
Rule number 1. Meet Mr. Market. It's all about dealing with the noise. Seriously, if you only take one single thing away from this entire explainer, let it be this exact concept.
Picture this. Imagine you own a great local coffee shop. It makes steady profits, you've got loyal customers, you absolutely love the place. Now imagine you've got this moody neighbor, let's call him Mr. Market, and he storms in every single day. Day 1, he is totally euphoric, screaming, "I'll give you $1 million for this place." But then, the very next morning, he drags himself in, totally miserable, and says, "Man, coffee's dead. I'll give you 50 grand tops." Would you take him seriously? No way. You'd laugh and tell him to come back when he's sober. But weirdly enough, when it comes to stocks on a screen, people treat Mr. Market's wild emotional mood swings like absolute financial gospel.
And this right here brilliantly illustrates the difference between winners and losers. The broke amateur investor, they panic and sell whenever the market throws a tantrum, convinced the sky's falling just because prices dropped. But the intelligent investor, they use Mr. Market's crazy mood swings to their advantage. Think back to the 2020 crash, right? Incredible companies like Apple, Amazon, and Microsoft got way cheaper. Did their actual businesses suddenly become terrible overnight? Obviously not. Mr. Market was just having a massive meltdown, and that created a huge opportunity to buy great companies on sale. Remember, the market is there to serve you, not to instruct you.
Okay, moving on to rule number 2. Stop speculating. This is all about investing versus gambling. We desperately need to understand the difference here. Because, let's be honest, most people out there are really just gambling and calling it investing. Let's say I offered you a tiny sliver of a pizza shop, but you've never seen it, you don't know the owner, and honestly, you have zero clue if it actually even sells pizza. Would you buy it just because some random guy on the internet said it was going to blow up? Of course you wouldn't, but you know, people do this exact thing every single day by buying meme stocks just because someone on TikTok or Reddit promised it was going to the moon. So the crucial difference is this. Speculating is literally just buying a ticker symbol, hoping someone else comes along and pays more for it tomorrow. You're basically buying a scratch-off lottery ticket. Investing, on the other hand, is buying part ownership in a real, living business with actual employees, products, and revenue. Treating stocks like a scratch card leads to total disasters, exactly like the late 90s dot-com bubble, where people threw cash at companies with zero revenue just because they had .com in the name. Treating stocks like real businesses? Well, that is how you build lasting wealth. That brings us to rule number 3, margin of safety, building your defense. Because look, no matter how smart you are, we live in an unpredictable world. Things can, and absolutely will, go wrong. 30,000 pounds. Benjamin Graham uses this absolutely brilliant analogy for this concept. If you're building a bridge, and you know the absolute heaviest truck that will ever cross it weighs 10,000 pounds, do you engineer the bridge to hold exactly 10,000 pounds? Absolutely not, right? You build it to hold 30,000 pounds, just in case. That extra 20,000 pounds, that's your cushion. And you've got to apply that exact same room for error to your portfolio. The economy can flip, a CEO can make a massive mistake, or the market can just panic. You need that buffer to survive.
And the way you create that bridge cushion in investing is beautifully simple. Just don't pay full price. A great business at the wrong price is still a really bad deal. If you calculate that a company is intrinsically worth $50 a share, the intelligent investor waits patiently until it drops to $30 or less. Back during the 2008 financial crisis, rock-solid companies like Johnson & Johnson and Coca-Cola were trading way below their real worth. That is exactly when Warren Buffett was grabbing value on sale, instead of chasing FOMO when the market was running hot. Your edge isn't just knowing what to buy, it's knowing exactly when to buy it.
All right, rule number 4. Pick a side. Know your style. Benjamin Graham pointed out that making this major internal commitment early on will literally save you years of frustration.
Think about it like going to the gym. Are you a defensive investor or an enterprising investor? The defensive investor is your casual gym goer, right? They just want to stay healthy, jog a bit, lift some light weights, and go home. In the market, if you don't have the time or the desire to be a financial detective, then be defensive. Buy boring, beautiful, broad index funds like the S&P 500. Invest consistently and just let compounding do the heavy lifting. On the flip side, the enterprising investor is the bodybuilder tracking every single macro and workout. They love reading financial statements on a Saturday night and hunting for undervalued stocks. And you know what? Both are perfectly fine, as long as you know which one you are.
But here is the massive red flag. There is no middle ground. Seriously, do not play in the middle. Playing in the middle is exactly where people get completely wrecked. They don't have the time to do the deep research of an enterprising investor, but they get bored to tears by defensive index funds. So what happens? They end up chasing trends, buying high, panicking when the price drops, and selling low. They lose their money, and honestly worse than that, they lose all their confidence. Pick your side and stick to it.
Finally, we reach rule number 5. Master your emotions. Conquering your own mind. This is literally the glue that holds the entire framework together. Without this, those other 4 rules, they completely fall apart.
Really let this truth sink in for a second. The difference between successful investors and broke ones isn't intelligence, it's emotional discipline. We have all seen this play out. The market drops 5%, and suddenly everyone acts like the world is ending, panic selling their entire portfolios. Or the exact opposite happens. A random stock explodes overnight, FOMO kicks into high gear, and people are YOLOing their life savings into a dog-themed meme coin. Your job isn't to control the market. That's literally impossible. Your job is to control yourself when everyone else is losing their heads.
So how do we actually pull this off in the real world? Well, to survive, you've got to automate your discipline with a solid system. Step 1, dollar cost average. That means you invest consistently every single month, totally ignoring what the market is doing. Step 2, rebalance annually, just keeping your risk profile in check. And step 3, ruthlessly ignore the noise. Think of it like a pilot flying a plane through heavy turbulence. The pilot doesn't start panicking and wildly yanking the wheel around, right? They rely entirely on their instruments and follow the system. When you have strict rules, you never have to make decisions based on hype or panic.
Okay, I want to leave you with this final, absolutely vital question. Are your daily financial choices building a system for long-term freedom, or are you just reacting to the noise of the crowd? Take a really hard look at your portfolio today with this new Benjamin Graham mindset. Ask yourself if you're truly investing like an owner or if you're just playing Mr. Market's chaotic game. Because I promise you, the moment you step out of the chaos and start treating wealth like a system, everything changes. Thank you so much for joining me on this explainer, and I really hope this completely changes how you view